And now, an Envision Financial podcast with Luke Smith on Canberra's 2CC.
Well, it's time to say good afternoon, Luke Smith. I think it seems like just yesterday, doesn't it?
It's quite surprising. Every day feels like Friday when I sit here. It's crazy.
Oh, yeah. It's been a big week, though, of course, with the wild weather last night ruining the game for people brave enough to attend at GIO Stadium. Cameron Ciraldo apparently putting his fist through the window. No, he was just trying to open it. He wasn't angry. He was just trying to open the window.
Oh, dear.
Because it was getting fogged up and,
Oh, dear.
Yes, and the change rooms, again, water flooding in through the ceiling. That stadium needs to go.
It's the coldest place in the world. As a young kid who grew up there, it's the coldest place in the world. Mm-hmm. And my mother has said that for years, and she spent time living in Iceland. So she knows cold. But, yeah, it's probably definitely due for either a refurb or we drag it somewhere special and save the commute for the people that attend it.
Absolutely. All right, let's get down to business today. Yep. We're talking about the current conditions prevailing around the world. There's a lot of uncertainty.
Yes.
There's a lot of volatility. Obviously, there's conflict in the Middle East. There's also the innate uncertainty of what President Donald J. Trump may or may not do next.
Yep.
So in this environment, it's no surprise markets are under pressure. So how can people make the most of this uncertainty, this volatility? What do people need to remember?
Yeah, I think people need to remember that 95% of your investments are a marathon and not a sprint. And as cliche as that sounds, it's very easy to get caught up in the sensational nature of news. And that's not to downplay what's happening overseas, because that's really, really serious. And I think to a large extent, we care about what's happened only because of the fuel price, because we all know that the Middle East love a war. And it's not new. However, it's new to us in the sense that it's starting to affect us financially. So I think people need to keep in mind that whether it's an investment portfolio outside of super or within super, the duration of your superannuation is going to outlast a war. It's going to outlast a president. It's going to outlast economic policy. And people need to be cognizant of the fact that it is something that will provide you with capital growth and income over the longer term. And there will be periods of instability and market weakness like we are seeing. I think the magnitude of what's happening at the moment is really overplayed, because I've had people coming in all week going, it's all gone, I've probably lost 20%. We made 8% March to March. We did 10% March to March. We did 6% March to March. Depending on when people have invested, their risk profile, what they've bought, what they hold, there's a myriad of things that can affect the return. But when we sit down and say, look, here are the numbers March to March, and they go, so I've still made that. Yep. It's not the doom and gloom that people are expecting, because if you take out the impact of what's happened overseas from sort of the middle of January, markets have had very, very strong 12 months. And they're still very, very positive, even through to now, taking into account the corrections that we've seen. And I stress the word correction. It's just a revaluation. I find people lump two things in the same bucket. The value's gone down, that means my income's gone down. No, not necessarily. The change in value of an investment, like an ETF or a share, is a reflection of sentiment. Do we like it? Do we not like it? People can be rational, they can be irrational, and there's a range of things that can influence the perception of something's value. That doesn't mean that it is necessarily less profitable than it was before. So don't make the assumption that, the share price is down, my dividends are down. That's actually not the case. Banking Royal Commission, great example. And I bring this back to its simplest form. Price of a bank goes down during the Banking Royal Commission because they were monsters in the eyes of the public, okay, rightly or wrongly. During that same period, CBA, for example, went from 80 to 60 in value and came out through the Banking Royal Commission and said, we've just made $5.5 billion profit and produced a really nice income stream. Don't make assumptions that will roll you up and get you upset at night. Keep in mind that now's probably a good time to keep nibbling away and buying something. Dollar cost averaging is a great strategy. Nobody knows what's going to happen in markets, and we've seen the valuation of assets change over the last 4 to 6 weeks in light of all of the pressures that are on the domestic economy and the global economy. But if you keep buying at weakness now, in a year or two when we're not talking about it, like we're not talking about COVID, in the eye of the storm, things are scary. But it will pass. The world's not going to end. Do we have to pay a bit more for some fuel? Yeah. Does anybody like it? No. And there are flow-on effects that will affect us for the foreseeable future. And I think people need to accept that for probably the rest of this calendar year, things are going to be expensive. Avocados might end up costing $10 each. We don't know. Let's see where it goes. But the fuel cost at the Bowser is just one part of a broader economic set of headwinds that the government are going to have to try and do something about in conjunction with the RBA, and we saw that this week with a rate rise. I would be expecting a couple more because inflation is going to skyrocket in light of the cost of fuel. Inflation will go up. Cost of living is going to go up. Everything's going to come under pressure. That'll push up inflation, and they'll need to up rates to try and curb that like we saw coming out of COVID. So keep in mind your asset allocation. Keep in mind the risk profile that you maintain, and maybe have a look and see what your balanced option actually holds. Because this is where I find people become very interested in their underlying assets, because they look at the change in value from week to week, month to month, quarter to quarter, and your underlying asset allocation, i.e., how much do I have in Australian shares, how much do I have in international, how much do I have in property, will influence the magnitude of the change in value, both good and bad. And I think people need to be careful that if you get cute and go, all right, I'm out, I'm going to cash, and sentiment and language around this problem changes and we see things recover very quickly, you could get caught out of the market and it could cost you a lot more than you realise. We saw a window into that last year with the talk around tariffs. Markets fell and recovered very quickly because someone said, I'm going to, no, I'm not going to. And we saw huge swings in index values. This, to a lesser extent, will occur like we saw coming out of COVID. It fell very quickly. It sort of normalised. And then, depending on the news and the outcome of the news and the actions taken, we saw an increase in value back to and exceeding where we were prior to the start point. And I think people need to keep that in mind and reflect on how they felt through COVID and what they did. Because the vast majority of people, let's be fair, are going to do nothing. Because when I asked them, what did you do through COVID? They said, oh, nothing. And you came out the other side and you were okay. Yes, we were fine. The people that sold were the ones that got hurt the most because it recovered very quickly and rebounded. And then you wait for another pullback to buy in and it never comes. So I think it's very prudent for people to maintain their position. I think it's an opportunity to look at the position of individual shares. CSL's a great example. Things got absolutely carted out over the last sort of 6 to 12 months and is probably trading at 2012, 2014 levels. Now, if you paid $300 for that and it's now trading at $140, great time to look at locking in that capital loss by selling, staying out of the market for a while and buying back, or selling in one entity and buying back in another, because you might like the CSL story, for example, and that of any stock, where you hold it for the longer term, but that capital loss is not wasted. It's accrued and held forever and used to offset capital gain in the future. So don't just look at this as, oh, the value's gone down. Look at it more strategically and say, well, how can I use the change in the assets that I have to my advantage in the future, where you may want to take profit and offset capital gain with capital losses, or look at it as an opportunity to continue to buy into a sector that's come under pressure. It won't be under pressure forever. And that's the joy of using well-diversified ETFs. You're not hanging your hat on an individual company as such. You're holding a range of investments in a particular part of a market. Now, is that market going to stay under pressure forever? Probably not. So now would be a good time, especially leading into 30 June, if you're making super contributions. If you're not going to buy all of something, buy some. I'm not against someone saying, we're going to hold $30,000 of that. Let's buy 15 now. It's off 10 or 12% since Christmas. Let's buy 15 and let's just sit and wait. Because you're never going to time it perfectly. But nobody ever got upset about buying a little bit more, a little bit cheaper. People get upset about going neck deep right out of the gates and then go, wouldn't it be good if I bought some now, 6 weeks later? Well, you don't have any cash. So if you want to try and mitigate risk, just dollar cost average, set up a savings plan, add to something regularly, and build out your portfolio in asset classes that have come under pressure with the long-term view of taking advantage of a recovery at some point in the future.
You mentioned a moment ago about people might be tempted to shift their focus from equity investments to cash investments. In an environment with inflation going up and therefore interest rates also likely to go up, that might be attractive to some people.
Yes, very much so. Could also be very dangerous because cash doesn't grow and we need growth to offset inflation. So at any point in time, you have to sit down and say, what is my primary concern? What is the worry that I have? Is it the quality of what I hold or just the perception of its value today? And you look at something and say, well, that's a great company, or that's a great index, or I've got a spread of this, this and this. Yes, the entire market is under pressure because of the headwinds that we are facing. But you can't then go and throw the baby out with the bathwater, because if you've got $1 million portfolio and this thing bounces 10%, there's $100,000. That's a big number. And you're willing to flip a coin on that? Probably not. If there are individual investments that are in sectors that are under huge amounts of duress, then you may look to get out of those just to limit the downside where that's applicable to you. But if you've got a diversified portfolio, I look at it as a positive and go, right, what could I do to get more into that and take advantage of this with a 5, 10, 15-year position? Because for most people, and I argue the point of your time horizon is tied to your retirement. No, your time horizon for investment is tied to the length of your life. I don't believe that you need to change your risk profile the day you retire, because no one's come into me and said, Luke, I'm going to retire next week. I don't want income. I don't want growth. I don't want to offset inflation. No one's ever come in and said that. So my argument is you need a mix of growth assets regardless of your age, because it's the thing that will offset inflation in a high-cost environment, whilst also providing an income stream that is consistent to help fund pension and retirement costs.
Luke Smith from Envision Financial is with me in the studio today, and we're getting deep and meaningful about the current volatile conditions in the market. Luke, tell us, what are the key things we need to remember?
Yeah, so I think keep in mind that time is your friend. And I would measure this by saying to people that, like we saw through COVID, there are periods of time when things will come under pressure, and there will be periods of time when valuations will fall, and there will be periods of time when valuations recover. And we saw that pre, during and after COVID with house prices as a great example. Things got a little bit expensive and then they normalised and they came off a bit. Doesn't mean the housing market's under pressure and going to crash. It's just we had an unrealistic valuation for a period of time. We're seeing the opposite at the moment with the concerns over what's happening in the world, and not to downplay the severity of what's happening, but just keep it in context. You have plenty of time for things to recover. You're not going to go and spend all of your superannuation money in the next 2 years. If you are, then you shouldn't be worried about markets at all, because you're going to tie it on that well that you'll have nothing left, and that's awesome. But it's
not really.
It's the context that people need to keep in mind. Keep investing, keep buying. This is a great time to be saving into a market. It's a great time to be saving into a portfolio. Dollar cost averaging is your friend, and that just means you put a little something in every month or every quarter and add to the positions that you have. You're averaging in for exactly this reason now. Things have come off. You can buy things that were a little bit cheaper than they were 4, 5, 6, 7, 8, 10 weeks ago. Look at your asset allocation. If you're at home and you're really sweating about what's happening, remember to look at things in a percentage manner. And I find people come in and they go, oh my God, I've lost 20,000. Oh my God. And I go, okay, but 20,000 out of what? Out of 20,000 or out of 2 million? Because if it's out of 2 million, who cares? As a percentage, what is the rate of change? Don't let friends' conversations and friends' experiences and friends' views influence or cause you anxiety when you don't have the context that they're talking about. Oh, my sister's lost 50,000. Again, out of 50,000 or out of 1 million? Out of 1 million, okay, not a big deal. We're not talking about big swings. Keep the context of the information you're consuming in balance, because it's that news and that fear and that sensationalism that then makes people go, oh, I'm out. They sell, it recovers, they miss out on huge amounts of money and then wish they never did. If you want to talk to someone, talk to someone. Don't sit at home stewing over it. And don't sit at home stewing on assumptions. Because I've had plenty of meetings this week where people walk in and go, oh, we made 8% for the year. Great. We made 10, we made 6, we made 7. Whatever they're doing. I say, yeah, we've made this much. And they go, oh. And they look up at the board and they go, oh, it's not minus 10. What made you think it's minus 10? Again, it's the news, it's the momentum. So keep that in mind. Be consistent. Stick to your knitting. This too will pass. Things are good, they go bad. Things are bad, they go good. You just need the context to keep things going. If you're buying fixed interest, think about buying shorter duration assets. What I mean is, don't go and buy 12-month term deposits now. Look at 3 and 6 months, because if we have a couple of rate rises, you don't want to be locked into something where you don't get the benefit of a rate rise. So keep those things in mind, and you'll be able to come out the other side of this storm intact.
Fantastic. Luke, can you tell listeners where they might find more information?
Yeah, look, office number 6260-4749. envisionfinancial.com.au on the internet. Podcast is the Strategy Stack of Luke Talks Money on iTunes and Spotify. We've got Envision Financial Canberra on YouTube, where we've got a back catalogue of all of our shows. And we have Smart Money Strategy, your ultimate guide to financial planning, with an entire chapter on asset allocation and diversification, as well as dollar cost averaging for those that want to know more about what that means.
Fantastic. Luke, thanks very much.
See you next week.
We'll catch up with you again next Friday afternoon at the same time between 4:30 and 5 o'clock right here on 2CC.